Today, I'm going to share the top 10 most important dividend increases that were just announced recently. This is from top dividend stocks that consistently grow their payments every year. If you are a dividend growth investor, this is vital to keep an eye on. Throughout the video, I'll share the percentage of dividend raise, the new payment amount, current yield, payout ratio, and more. Plus, I'll give an overview of key financial metrics and stock performance. With that said, let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. If you click the link in the description and pinned comment, you can get my free email newsletter, where every Monday I share with you the top dividend increases. If you become a member of DividendData.com, you can get that dividend news filtered by just the stocks you own, plus the stock analysis tool that I'll be using throughout the video. For stock number 1, I'm going to use the Coca-Cola company, ticker symbol KO. They just announced their 63rd consecutive annual dividend increase. That was a 5.2% raise to 51 cents per share. This news just broke, so it's not yet reflected over on DividendData.com, but that will bring the annual dividend payment to $2.04. That would give the company a current dividend yield of 2.91%. This 5% dividend increase should be around your expectations if you're investing in Coca-Cola stock. Their prior dividend increase was 5.4%, so this new increase is definitely in line with that trend. However, the 5-year compound annual growth rate of the Coca-Cola dividend is actually slower at 3.93%. So dividend growth is picking up a little bit. Coca-Cola is a dividend king that has been increasing its payment on an annual basis for decades. It's a very mature company that pays the overwhelming majority of its cash flows out as dividends. The payout ratio is around 78% based on net income, and historically is around 80% based on free cash flow, although they had an outlier year in fiscal 2024. This is a very high quality and reliable business, but they do trade at a pretty high valuation. So I would keep your expectations low in terms of total return from Coca-Cola stock at these prices. Earnings growth and dividends growth is pretty slow at the company, although analysts are projecting higher earnings per share growth in the coming years from Coca-Cola stock. If you're buying Coca-Cola, you're really buying it for that reliable dividend payment. And the yield's actually pretty low right now relative to the historical price Coca-Cola trades at, and dividend growth isn't that high. It's for that reason that the 5-year total return is only 39.4% for Coca-Cola. Although historically, this is a reliable company that should compound money and pay you a growing dividend. Since 1990, their total return is 3,200%. For stock number 2, I'm going to share Meta Platforms, ticker symbol META. They just declared their first dividend increase, which was a 5% increase at $0.525 per share. Meta is the big tech juggernaut that owns Facebook, Instagram, and WhatsApp. They have had just stellar earnings and free cash flow growth, which has led to great stock price growth. And the company is now a cash cow with $91 billion annually in cash from operations. And although they're investing a ton in AI infrastructure right now, they are still generating $54 billion of annual free cash flow. And that 5% dividend increase, although conservative, shows that they may start this pattern of annual dividend increases. And the company definitely has the cash flow growth to back this up. This current annual dividend is $2.10, which is a 0.3% dividend yield. However, the payout ratio is still super low. They just completed their first year of paying dividends, and they had a 9% free cash flow payout ratio and 8% net income payout ratio. And fiscally, Meta is a dominant growth business. The 5-year compound annual growth rate of revenue per share is 21.25%. Free cash flow per share is growing at a 5-year compound annual growth rate of 23.48%. They have a strong balance sheet, negative $28 billion of net debt. If you're a younger investor who wants to focus on total return and looking for a dividend growth stock of the future, Meta Platforms will likely be a great pick. The 5-year total return at Meta is 247%, and since going public in 2012, the stock has seen a 1,900% total return. And the interesting thing is that Meta actually trades at a very similar PE multiple to Coca-Cola, despite having far higher growth in really every single financial category. For stock number 3, I'm going to share Realty Income, ticker symbol O. This is a monthly dividend stock. That's why it's extremely popular in the dividend investing community. They raise their dividend multiple times a year usually, and they just announced a 1.5% dividend increase. This is a real estate investment trust, or a REIT. As you can see, earnings per share grow at a reliable rate for the company. And the stock price has actually sold off recently, creating an interesting opportunity in terms of dividend yield. The forward-looking annual dividend for Realty Income is $3.22. That gives it a 5.69% dividend yield. The 5-year compound annual growth rate of the dividend is 3.49%. And the payout ratio is reliable based on free cash flow, always around the 70% mark. And REITs have a little bit of a unique financial characteristic to analyze. They're also required to pay out most of their income as dividends to shareholders. The recent sell-off at Realty Income has created an interesting opportunity where the dividend yield is at a historically high range. But that sell-off also means that their total return has been terrible for the past 5 years. However, over the long term, this has been a fantastic compounder. Since going public in 1994, they have a 4,200% total return. So given the weak performance lately, this may actually be a pretty interesting entry point for Realty Income stock. At a minimum, you have a pretty high yield dividend payment that you can just reinvest or take the dividends as cash flow. So this is definitely an interesting one if you're close to retirement. For stock number 4, we have Sherwin-Williams, ticker symbol SHW. They just declared a 79-cent per share quarterly dividend, which is a 10.5% increase. This company has seen pretty great long-term performance, and that can be attributed to their high earnings per share growth. This is a low yield company, however, with a current forward-looking annual dividend of $3.16, giving it a 0.9% dividend yield. You do get high dividend growth though, with the 5-year dividend CAGR at 12%. The increase prior to this was 18%, but in 2023 they had a very low increase at 0.83%. This is a very sustainable dividend payment too, based on both net income and free cash flow. On top of dividends, the company is regularly buying back stock. This is another way they return capital to shareholders. The company's dividend yield, though, is historically low right now. The investment performance has been pretty good with a 5-year total return of 93.6%. And since 1990, the stock has crushed it with a 20,800% total return. The question is whether they keep that up in the future. For stock number 5, I'm going to share Occidental Petroleum, ticker symbol OXY. This is one of Warren Buffett's recent public stock purchases. They just announced a 24-cent per share quarterly dividend, which is a 9.1% increase. This is one of the big oil companies in the United States, so their earnings and cash flows fluctuate dramatically based on the commodity price of oil. However, unlike other oil giants like Exxon and Chevron, Occidental Petroleum does not pay a reliable growing dividend. In fact, that dividend payment has been cut multiple times in the past. They are now growing it back from a smaller base. The current forward-looking annual dividend is $0.96 with a 1.84% dividend yield. It's a quarterly dividend payer. The current payout ratio based on free cash flow is very low at 32%, and it's 60% based on earnings per share in the past year. But during boom oil times like 2022, that was as low as 8%. And this company was not in a good financial position going into the 2020 oil crash. They had a ton of debt, so they used a lot of that free cash flow just to pay off their large debt. And now they're in a little bit of a healthier position. This company actually hasn't even done that well compared to some other oil companies coming out of the pandemic. Their 3-year total returns 40.9%. 5-year total returns 41.4%, but that catches right before the pandemic crash. Since 1990, the company has a 1,100% total return. I personally think there's a lot of better oil and gas stocks to buy. For stock number 6, I'm going to pick Waste Management, ticker symbol WM. They just declared a $0.825 per share quarterly dividend, which is a 10% increase. This is a reliable company that has continued to grow earnings, and their stock price has followed suit over time. They do trade at a relatively high valuation, though. The forward-looking annual dividend is $3.30, which gives it a 1.44% dividend yield at current prices. The 5-year compound annual growth rate of the dividend is 8.65%. This recent 10% increase is actually an acceleration. The 2 prior increases were around 7%. The dividend is sustainable with a 56% free cash flow payout ratio and 44% net income payout ratio. The current dividend yield for Waste Management is actually historically low, so this company is definitely trading at a premium right now. The 5-year total return is 100%, and since 1991, they've had a 2,200% total return. For stock number 7, I have NextEra Energy, ticker symbol NEE. They just declared a 10% dividend increase for their quarterly dividend. This is an electric utility company. They've grown earnings per share pretty high over the past decade, and that's led to pretty good stock price growth. Analysts are currently projecting earnings per share growth just below 10% for the coming years. If we look at the NEE dividend, their current forward-looking annual dividend payment is $2.27. At current prices, that's a 3.23% dividend yield. The 10-year compound annual growth rate of the dividend is 11.4%, and they've basically been increasing it 10% every single year. The payout ratio is sustainable, typically based on net income, but usually their free cash flow payout ratio is completely unsustainable. And they have been able to grow their cash from operations significantly over the past decade, but most of that has come through debt. The company has $80 billion now of net debt. So we'll see how that turns out. The starting dividend yield's not bad. And if you were bullish on the company, in early 2024, it sold off a lot, and you could have gotten it at a 3.7, 3.8% dividend yield. It's done pretty bad over the past 5 years with a 15% total return. But since 1990, this has been one of the best utility stocks with a 5,700% total return. So if you're a dividend growth investor looking for a utility, this may be an interesting one to have your eye on. For stock number 8, I have a company I've never heard of before, but it looked kind of interesting when I took a look at the financials. That is Comfort Systems, ticker symbol FIX or FIX. They just declared a 40-cent per share quarterly dividend, which is a 14.3% increase. And you might say, why did I find this interesting? Well, you can see that their earnings per share have just boomed, and the stock price has completely gone nuts since 2020. But with a surface level look, that seems to be backed up by earnings per share growth. The company pays a quarterly dividend and they increase it multiple times a year. Recently, they have switched to a pattern of increasing it every other payment. So just 2 dividends ago, they did a 20% dividend increase. The 5-year compound annual growth rate of the dividend is 28.47%. With the forward-looking payment of $1.40, the current dividend yield is 0.37%. But that doesn't mean they don't generate a lot of free cash flow. Their payout ratio is super low. Their payout ratio based on free cash flow is 5%, and based on net income, it's 8%. So this company's valuation is much more reasonable. Revenue per share is growing at a 22% 5-year compound annual growth rate. Net income per share is growing at a 36% 5-year CAGR, and free cash flow per share is growing at a 47% 5-year compound annual growth rate. The company has a good balance sheet with over $500 million in cash and short-term investments and negative net debt. So I'm going to be honest, I have no idea what this company does, but just taking a look at the financials, I'm going to add this stock to my watch list. The current dividend yield is historically low for Comfort Systems stock, but that's because the price has gone up and the company trades at a high multiple. However, that seems to be justified based on the high growth rates they are experiencing. Could you imagine buying this stock, though, in 2020, locking in a 1.3% yield? You would have had a 720% total return. That's over the past 5 years. Since 1997, the company has a 2,900% total return. And based on this, it seems like something happened in 2020 with their business model where they just exploded. For stock number 9, I have American Homes for Rent, ticker symbol AMH. They just declared a 30-cent per share quarterly dividend, which is a 15.4% increase. The forward-looking dividend payment for them is $1.20, which gives them a 3.36% dividend yield. The company has seen a lot of dividend growth, though, with a 5-year compound annual growth rate of 43%. However, they've only been increasing it on an annual basis since 2020. And that dividend growth has slowed down, but it's still pretty high at 15%. So for a starting yield of 3.36%, that's some pretty high dividend growth. The payout ratio is sustainable based on free cash flow, currently sitting at a 55% free cash flow payout ratio. However, based on net income, this dividend has appeared to be unsustainable, other than in fiscal 2023. I don't know much about this business, but it seemed like an interesting dividend stock to share. The dividend yield is actually historically high for the company. Since going public in 2013, they have a 163% total return. Finally, for stock number 10, I have the New York Times, ticker symbol NYT. They just declared an 18-cent per share quarterly dividend, which is a 38.5% increase. And no matter what you think of them politically, because I'm sure a lot of you have various different opinions, their business has gotten a little more interesting. We all know newspapers are dying, but they have now transitioned pretty well to a subscription digital media company. And you can see that just in their dividend payment. They had to completely cut their dividend because they were going through a massive transformation. But now they have brought it back and their financials are improving year after year. And that dividend payment is growing once again. The 5-year compound annual growth rate of the dividend is 29.2%. The forward-looking annual dividend payment is 72 cents per share with a 1.48% dividend yield at current prices. And the payout ratio is still very low with a 20% free cash flow payout ratio and 30% EPS payout ratio. If we look at their business overall, you can see that earnings per share is consistently climbing, recently hitting an all-time high. Free cash flow is also improving and the company is becoming consistently profitable at a high level. They also have a strong balance sheet with negative $500 million of net debt. With the dividend increases, the yield is climbing up to recent highs. The 5-year total return's 32%, and the stock has done very bad historically given that they had this massive transformation away from legacy into a new digital media company. And the New York Times as an investment has been a complete mess over much of the past few decades. I don't think I'll be adding this to my portfolio, but I kind of have my eye on it as like a case study, and it's a little interesting. All right, so those are 10 dividend stocks that just announced dividend increases. If you enjoyed the video, please leave a like, comment, and subscribe to the channel. And if you want to get breaking dividend news like this straight to your email inbox, then click the link in the description and pin comment to sign up for our free email newsletter. Also, you can sign up at dividenddata.com to get this entire stock research platform I've been using throughout the video. With that said, I'll see you in the next one. Thanks for watching.